Welcome back to the deep dive. Today we're tackling the consolidated financial statements for Destek Finance Factoring. You sent this one over, and it's a really interesting one.
It is. It's complex. You've got this mix of a, let's say, traditional finance business that's suddenly bolted on this really aggressive banking operation.
So our mission today is to, cut through all that complexity.
That's right. We're going to
Right.
translate what this rapid expansion really means. We'll look at the numbers for the first 9 months of 2025, compare them back, and really focus on what it all means for you, the individual investor.
And before we get into the weeds, if you find this kind of breakdown helpful, please, do us a favor, hit that like button, subscribe to the channel, and maybe share this with someone else who's trying to figure these things out.
It really does help.
Okay, so let's first get to know the company a little. Where are we talking about here?
Well, the group is based in Istanbul. Headquarters are in the Furko Signature Tower in Şişli.
Okay.
And their core business, the factoring side of things, that's been around for a while, since 1996.
And what exactly is factoring for anyone who's not familiar?
It's a type of finance. So say you're a business and you have a bunch of unpaid invoices. You can sell those invoices to a company like Destek at a discount, and they give you cash right away. It's all about short-term working capital.
Got it. So that was their bread and butter, but you said that's changing fast.
Oh, completely. This is not just a factoring house anymore. The real growth and, frankly, the complexity comes from their subsidiaries.
And the main one is the new bank.
Exactly. Destek Yatırım Bankası, they own 99.99% of it, founded just back in 2021. And the key thing to know about this kind of bank, a development and an investment bank, is that it can't accept deposits.
So they can't just use customer savings to fund their loans.
Right. They have to go out and borrow the money themselves through bonds or loans, which, as you can imagine, puts a lot of pressure on their costs.
And then that bank has its own subsidiary, too.
It does. It owns a brokerage firm, Destek Yatırım Bankası. So in just a few years, you've seen them pivot from this niche factoring firm to a full-service financial group.
That explains the hiring spree, then? I saw their employee count jump from, 159 to 209 in just 9 months?
They're scaling up like crazy, and the man behind it all is the controlling shareholder, Altıns Kamova. He runs it through Destek Holding, which kept a 75% stake when they took the company public on Borsa Istanbul back in February 2025.
Okay, so they're public now. Let's talk about something that really jumped out of the footnotes, something that always gets investors' attention: executive pay.
Yes, and we should probably clarify for everyone. We'll be using the term bin TL, which just means thousands of Turkish lira. So note 23. For the first 9 months of 2025, total compensation for the board and senior management was 95,279 bin TL.
So about 95 million lira. And how does that compare to the year before?
Well, for the same period in 2024, it was 24,377 bin TL, just over 24 million.
Wait, hold on. So it's basically a four-fold increase year over year.
A near four-fold increase, yes.
How do you even interpret that as an investor? I mean, on one hand, it looks like a massive red flag. On the other, they did just pull off a huge IPO and this massive strategic shift.
And that's the tension, isn't it? It's almost certainly performance-driven, bonuses tied to the IPO, growth targets, all of that. But an increase of that sheer size, that's 70 million lira more than the year before. It just puts immense pressure on them to keep delivering.
The performance better keep up with the paychecks.
You've got it.
All right, so let's zoom out a bit. They're operating in a pretty tightly regulated financial sector in Turkey: BDDK, SPK, all the acronyms.
Yeah.
How are they positioning themselves in that environment?
I think a quick SWOT analysis built from the data really clarifies things. Their biggest strength is just raw momentum. Total assets are exploding, equity's growing, and even their original business, factoring, is still firing on all cylinders. Revenues there are up from about 3.4 billion to 5.2 billion lira.
So the core is strong while the new stuff launches, but there has to be a downside to that kind of move fast and break things strategy, a weakness.
Oh, absolutely. And it's cost. This
Yeah.
kind of expansion is incredibly expensive. We just talked about executive pay. But look at personnel expenses across the board. They more than doubled, from 176 million to over 514 million lira.
Wow.
That kind of expense growth eats into your margins no matter how fast revenue is growing.
Okay, but they're not just burning cash, right?
Yeah,
They're investing. I saw notes about that, the opportunity.
Yes, and that's a really good sign. They're making serious investments in infrastructure. They added over 63 million in intangible assets, which is mostly software IT platforms,
Hmm.
the backbone of a modern bank.
And physical assets, too.
Yep, another 74 million in tangible assets. Think new offices, equipment. They're building for a company much larger than they are today.
Which brings us to the threats. Regulation is one, but you mentioned their funding model.
It's the biggest one. That tax rate hike for financial firms from 25 to 30%, that stings. But the more immediate threat is their reliance on debt. Since the bank can't take deposits, their entire growth engine runs on borrowed money,
Making them super sensitive to interest rates.
acutely sensitive. Any change in the cost of borrowing hits their bottom line directly.
Now we can move on to our analysis of the statements. Let's quantify this. Income statement first. Revenue looks great. Core factoring revenue hitting 5.24 billion lira.
It's fantastic momentum. But, and this is the big but, look at the line item right below it, financing expenses.
The cost of that borrowed money.
Exactly. It more than doubled. Went from 1.2 billion up to 2.45 billion. That's the price of this growth.
Still, even after paying that, their net operating profit is incredibly strong, up to 3.82 billion from 2.15 billion.
It is. They're managing the spread very well.
Yeah.
And it flows all the way to the bottom line. Net profit soared to 2.58 billion.
And the key metric for shareholders, earnings per share.
It's also up from about 6.06 to 8.02. And this is really important because it shows that even with the new shares they issued in the IPO, the new capital is working hard. It's generating more profit for every single share.
That's a very positive sign. All right, let's pivot to the balance sheet because this is where you really see the strategy in action. Total assets almost doubled.
In 9 months, from about 24 billion to almost 47 billion lira.
So where did all that new money go?
Well, some of it went into their core business. Factoring receivables grew nicely, up to 19 billion. But the truly staggering number is in other financial assets. That's mostly the bank's standard loans.
And that number.
It's skyrocketed from 4.5 billion at the end of 2024 to 15.3 billion by September.
So they more than tripled their loan book in 9 months.
They've essentially become a commercial bank that also happens to do factoring. It's a fundamental shift in their risk profile.
Because standard loans are different from factoring receivables.
But very different. Often longer term, different kind of credit risk. It's a whole new ballgame.
And no surprise, this was all funded with a mountain of new debt.
A mountain. Total liabilities also doubled, hitting 35.8 billion. You see loans they've taken out, a London creditor, almost doubled to 18.6 billion. And issued securities, like bonds, up to 8.2 billion. The growth is fueled entirely by leverage.
Okay, this brings us to what you said is the most critical part of the story, the cash flow statement. They made 2.58 billion in profit on paper. So how much actual cash did the business generate?
And this is where the story takes a fascinating turn. Their net cash flow from core operations was negative.
Negative.
Negative 1.3 billion lira. And this is a complete reversal from last year when they generated a positive 1.8 billion.
Okay, a profitable company with negative operating cash flow, that sounds bad. Explain that for us. How is that even possible?
Think of it like a grocery store that's expanding like crazy. Your books say you're profitable because you're selling a lot, but you're spending every dollar of cash that comes in, and then some, to buy inventory for 10 new stores you're opening.
So the cash is going out faster than it's coming in?
Precisely. In this case, the new inventory is new loans and new factoring deals. They are issuing them so fast that the cash outflow to fund them is bigger than the cash inflow from customers paying off old loans.
So it's not a sign of losses necessarily, but a sign of just incredibly aggressive, cash-hungry growth.
Exactly. And the only reason their total cash on hand actually went up is because of cash from financing activities.
The IPO money and all that new debt?
Yep. They brought in almost 7 billion from financing activities. They're literally funding their day-to-day operational expansion with external capital.
Which means turning that operating cash flow positive has to be their #1 priority.
It's the whole game.
Let's quickly hit on equity and a couple of those footnotes you flagged. Shareholders' equity more than doubled?
It did, up to almost 11 billion, and that was driven by two main things. That 2.58 billion in net profit and the 3.8 billion in fresh cash they raised from the IPO.
So the IPO is critical for strengthening their balance sheet.
Absolutely, it gave them a huge cushion. And it's interesting, Note 17 shows their paid-in capital is still well below their registered ceiling, so they have room to raise more if they need to.
Okay, and you found something in the notes about how they account for loan losses.
Yes, Note 2.4e. This is a subtle but really important detail for anyone comparing them to other banks. The bank's subsidiary has an exemption from the regulator, the BDDK. It means they don't have to follow the latest TFRS 9 rules for calculating potential loan losses.
And TFRS 9 is the more forward-looking standard.
It is. It requires banks to anticipate future losses, which often means booking bigger provisions earlier. Destek uses an older method. It just means you have to be careful when comparing their provision numbers directly against a peer that's on TFRS 9. It's not apples to apples.
Got it. On a more positive note, though, it looks like they're managing the quality of all these new loans pretty well.
They are. The amount of non-performing loans, or takapteki alakaklar, actually went down slightly.
Which is amazing considering how fast the loan book grew.
It's a really strong sign. It suggests their credit approval and management teams are keeping up with the pace, which is not easy to do.
So let's bring it all together. What's the final picture here? It feels like a story of massive high-stakes growth.
It's a high-tension story. They've successfully executed stage 1 of their plan, used leverage and an IPO to scale up their assets and report strong profits.
But the costs are huge. Soaring expenses, massive debt, and this really critical negative operating cash flow.
Right. So the big question for them, for investors, for us watching, is can they get to stage 2? Stage 2 is proving that this bigger, more complex machine can actually become a self-sustaining cash generator.
Can they flip that negative $1.3 billion in operating cash flow back to a healthy positive number?
If they do, it validates the whole strategy. It proves the debt-fueled growth can translate into sustainable cash.
Yeah.
If they don't, well, then the market's going to start asking some very tough questions.
That is the number to watch. Thank you for joining us on the Deep Dive. We hope this gave you a clearer picture of what's happening behind the numbers. If it did, please make sure to like the video, subscribe, and share this with anyone you think might find it useful. We'll see you next time.